Good. So, good morning, everyone. Welcome to our first webinar on the FRS 102 Triennial Review. I'm Alex Hurd. I'm a partner who leads the Financial Reporting Advisory and Valuations team. I'm joined this morning by Laura Mashida, who is one of our audit partners and leads our not-for-profit division, and also Megan Utley, who's a senior manager in our tax team. We are going to run through, hopefully, a high-level introduction on the various changes to FRS 102, which is going to be coming up. And essentially, this is going to be quite technical in nature. Make no apologies for that. We have got a lot of ground to cover, so we're not going to be looking at too many complex examples. We're trying to focus on the key impacts and things that you need to be thinking about getting planning for. There is a Q&A that's available. If you want to ask any questions throughout the webinar, just drop it in the Q&A box, which should be on your screens. We will answer as many as we can at the end of this. And also just to say that this recording is being, this is being recorded. So we will be sharing the recording around later on. Your attendance and your faces won't be on that recording, but any questions that you ask obviously will be. Finally, this is verifiable CPD. So if you just make a note of your attendance at this, you should be able to record that for your status. We're going to start with revenue recognition. So I'm going to hand over to Laura to chat through the first parts of that.
Thanks, Alex, and good morning, everyone. You just hop on to the next slide for me. Thank you. So the FRS 102 periodic review sees the biggest step change so far in bringing UK GAAP in line with IFRS. This convergence has been ongoing for many, many years, but this round of changes brings some really key areas in line. So we start to see numbers change quite significantly in this periodic review. There's still many differences between UK GAAP and IFRS, so this isn't quite full convergence yet, but we are definitely starting to get there. So these changes do significantly impact accounts in the UK, and comparability between IFRS accounts and UK GAAP accounts will start to improve significantly. So just looking at the effective date of this periodic review, the new standards effective for periods beginning on or after the 1st of January 2026. So generally the first year end will be December 2026. But as always, we do need to take care and watch for short periods or interim periods, and that would bring the first reporting period forward if you had one of those. Just to flag as well that the standard does allow for early adoption, but you do need full adoption. So it's an all or nothing basis. And I think in reality, we probably won't see that too much, but in certain scenarios and with certain goals in mind, we might see people early adopting to get to a better accounting answer. Okay, so just look at revenue recognition in a little bit of detail. So that's one of the key changes. It's one of the key areas of change in the periodic review, and the new section new section 23 of FRS 102 was drafted significantly to bring it in line with the main principles of IFRS 15. So section 23 gives us a single 5-step framework for revenue recognition, really similar to what we see in IFRS 15. And applying the 5-step models helps us determine in a structured way how much revenue we should be recognising and when we should recognise that revenue. So we've got the 5 steps here. The first step is to actually identify the contract. Is there a contract setting out the rights and obligations? And then if there is, we continue to apply that 5-step model. Second of all, we look at the performance obligations within the contract. So these are the promises, and we see the word promise quite a lot as well. So the distinct goods and services which are to be delivered under the terms of the contract. Then we look at the transaction price in the contract, so the price over time which will be taken to revenue. And once we understand the price and the performance obligations, we allocate the price to the separate obligations. And the final step is to make an assessment of when the obligations have been satisfied. And when we're fully satisfied an obligation, we'll take the price to revenue. When they're partly satisfied, the revenue won't be fully recognised. We'll partly recognise revenue. But just to bring this to life a little bit with quite a straightforward example, if we take a washing machine that you bought for £500 with a 3-year warranty. Without the warranty, the washing machine would have been £350, so inferring that the warranty is £150. So we've got the contract, that's the money in exchange for a washing machine and a 3-year warranty. What are the promises or obligations? Well, the promises are washing machine on day one and the provision of a 3-year warranty. The transaction price, well, that's really simple on this one. So it's the advertised price for it. Looking at the allocation of the price, well, that's going to be £350 for the washing machine and £150 for the 3-year warranty. And then finally, look at how we recognise the revenue. So that would be £350 on delivery of the washing machine, so on day one, and then the warranty income we take equally over 3 years. So we take that £50 a year, which takes us back to the £500.
Okay, so the obvious question here is what changes? And the answer is pretty much nothing most of the time. There are a lot of technical changes, and it means that you're either going to be not impacted at all, which will be most reporters, or very heavily impacted, and there's a lot of work to do on this. Certainly, the experience of IFRS 15, which this is based on, suggests that most people will not be affected. Some of the key changes, though, construction contracts are removed entirely. So they are not mentioned at all in the updated standard. Everything is just point in time or overtime for how we recognise the revenue. And overtime is further broken down into 2 key methods that you can apply to this, either input method, where you base the recognition of revenue on the effort or cost that you have put into delivering that obligation, or the output method is where you recognise revenue by reference to the value transferred to the customer. The other key change is that any variable consideration is constrained and only included to the amount that is highly probable that it is going to flow to the entity. If it's not highly probable, then you don't recognise that variable consideration until a contingent event is settled. So some key examples where we think that there are going to be changes on this. So anything where there's some sort of bundled contract, if you are going to provide some sort of goods with services that complement the goods. So for example, providing a piece of hardware and the installation services for that hardware, you're going to have to think about those in a bit more detail. Variable considerations, sort of no win, no fee. I've got an example of that in a second. Warranty sales, as Laura's just been through. Anything where you've got sort of key financing components, any unusual terms around constructions. Principal versus agent becomes a bit more prevalent, so you can have different performance obligations carrying different indicators of principal versus agent. And software licensing as well, there becomes some pretty fixed rules around this, looking at whether you have a right to use IP or a right to access IP, and the accounting for the two is very different in terms of when you recognise that revenue. So to see how this might manifest itself as a problem in practice, we've got a firm of solicitors who enter into a no-win, no-fee arrangement with the client, who can get 20% of the client's award if they win in court and nothing if they do not. So the entire consideration is variable. So how do we account for this? Well, the firm has got a lot of practice of doing this, and they've got a reasonable estimate of what we think the client's award is going to be. Then we can apply an expected value approach, which looks at a portfolio basis. And this could basically be looking at a range of weighted probability outcomes. And on a portfolio basis, you know that some will win, some will not win, and therefore you can recognise the revenue. However, if this work is typical, but we haven't got any idea of what the award might be and can't place any sort of reliable estimates on it, then if we're going to get 20% unknown number, then that is a contingency that we can't manage with expected values. And then lastly, if the firm doesn't do this sort of thing normally, then we've got no reliable estimate for the outcome. And so we have to constrain that variable revenue to nil until the contingency of the court award is settled. In terms of transitioning to this, well, generally, any changes for this are going to appear in opening retained profits, so we don't restate the comparatives. What that means is if the revenue recognised under the new standard is different at the date of transition to updated FRS 102 to what it was under the existing standard, we just bring that difference into retained profits. You can optionally restate the comparatives. I think as that adds complexity to creating the accounts, I imagine most are not going to take that option. There's two further optional so-called practical expedients on this as well. So we can either account for the contracts completed by reference to data completion rather than re-estimating the comparative. And we can also look through any contract modifications that may have existed and just use the benefit of hindsight. So what's the key message on this one then? Well, in general, this is going to have little impact for most people. But for the small amount who are impacted by this, this is going to become a significant piece of work that needs to be done to look at updating revenue recognition. Disclosures are going to increase slightly, so there's going to be a bit more emphasis on how revenue is recognised, discussion around contract assets and liabilities. But I think mostly, unless someone is particularly sensitive to revenue recognition, such as they're selling a business, then anything wider than that is probably limited. Laura?
Okay, thank you. So let's look quickly at some charity-specific implications. So the charity SOP itself is still in draft, and we're expecting the exposure draft and consultation for that in early 2025. So the final SOP will probably come in autumn 2025, so that's still a little way off. So until we get sight of the actual SOP, we can only infer what it might require just from the changes in section 34 of FRS 102. So they're the public benefit entity requirements within FRS 102, and the SOP is drafted in a way that it has to comply with those requirements. So exactly the same as main FRS 102, the SOP will be mandatory for periods commencing on or after the 1st of January 2026. And the SOP can layer on additional disclosure requirements, so on top of the requirements of FRS 102. But until we've seen the draft, we can't really second guess what might actually be required. So for now, I'm only going to consider the reporting of the known changes in section 34 on FRS 102 on charity and reporting. On to the next slide. Thank you, Alex. So just in terms of income recognition, I think adopting the 5-step model is likely to impact how we examine contracts in charities and potentially how we recognise how we recognise income in charity accounts. So many contracts in charities contain deliverables or performance conditions, which are promises or obligations under the 5-step model. So we'll need to look really closely at these promises within the contracts and see how contract income or the transaction price allocates across the various promises. So one key challenge in charity accounting is distinguishing between what's a contract and what is a grant. And that's often a really thorny issue and sometimes really unclear, and it requires quite a bit of judgment in practice. So just because it calls itself a grant or a contract in the paperwork, it doesn't follow that that's actually what it is from an accounting perspective. And these new requirements definitely make this distinction really important. So it's basically step one in what is a contract in the model. So if we decide it's a grant, we move away from the 5-step model, taking all the income immediately. So it's really important to understand what's a contract and what is a grant. So where the arrangements are contracts and not grants, I think practically it might be quite a challenge for charities. So the model assumes that there's going to be granularity and detail available. And quite often it's just not there in the paperwork. So commissioners do tend to issue these block contracts, and there's many different requirements and obligations in there. And there's often no real price split in terms of what they're paying for which components. And they tend to be quite agile as well. So there's often some flexibility in the delivery, which can make the judgment call in terms of how we recognise the revenue quite a tricky one. So I think it'll certainly be an area of accounting and audit focus, and maybe working with the funders to make the arrangements a little bit more transparent in terms of the paper trail will really help from an accounting perspective. So I think that that's probably a priority for charitable organisations over the next 18 months or so. Okay, so moving on to leases. So for many, I think this will be the single biggest change. So this is a complete rewrite of section 20 of FRS 102 on leases. And so this section's been completely redrafted to bring it in line with the principles of IFRS 16. So in UK GAAP, we've always had the distinction between an operating lease and a finance lease, and this completely falls away in this periodic review. So the starting place now is that all leases are on balance sheet obligations with an associated right of use asset, which you'll then capitalise. The standard does exempt short-term leases of less than 12 months, and the standard also exempts some low-value assets, and I'll look at that in a bit more detail in the next slide. And happily, it's good news if you're a lessor, because we don't expect to see too many changes at all in terms of lessor accounting. Okay, so which changes can be potentially exempt from going on balance sheet? So first of all, we've got the short-term leases. So very simply, those that are on commencement have a term of 12 months or less, and they do not have an option to purchase written within them. That exemption is available irrespective of the value of the lease at inception. We've then got the leases of low value items. So section 20 doesn't give us a specific value or even the nature of the assets which can be exempt, but it does give us a list of some quite sector specific assets sometimes which can never be exempt. So those arrangements should be looked at on a lease by lease basis. So if you've got lots of individual leases for small items such as computers or tablets, you look at each one in isolation rather than aggregating. So they would all be exempt even if you've got lots of them. And just in terms of the treatment where we do take the exemption from capitalising the lease, the treatment's basically the same as the current treatment for operating leases. So the expense for the lease will be taken to profit and loss during the year, and there would be a lease commitment note included within the financial statement. So what is a lease? The first step in determining the accounting treatment is to determine whether you've actually got a lease or not, and then to understand the exact terms of the lease. So section 20 of FRS 102 lays out a definition of a lease as a contract that conveys the right to use an asset for a period of time in exchange for consideration. So the next couple of slides, we'll have a look at these requirements, and they're all highlighted in blue on the slide here, and what the standard means by them. So first of all, we need to separate the components of the contract. So agreements can often contain lease elements and non-lease elements, or multiple commitments even. So it's key to understand these so that we can properly account for them. So if we look at an example of a car lease, which is bundled with maintenance and insurance, in theory, you should split these out between running costs, which would go to profit and loss account, and the leases, which would be capitalised. But we know that some agreements don't give this information, or it's quite difficult to get behind, or even quite time consuming if you've got lots of leases like this. So the standard does actually have a practical expedient which allows you to elect for all of the components to be treated as a single right of use asset and a lease liability. And while that's useful, I think that this election won't always give you the desirable result. So if we look at a building, for example, so maybe a retail unit where you've got a lease charge and a service charge, that election starts to look a little bit less attractive, because you'd be capitalising a significant extra liability by taking that expedient. And then we'd also have to look at what we've capitalised and take a view on whether or not we think it's actually impaired or not. The lease term is also key. So very generally, this will be the minimum non-cancelable period. So more often than not, we'll look at the first break period. But it's not that straightforward. So we do need to consider the intention when the lease was incepted and the likely outcomes given the facts that we know, so the facts in play. So if you think about an example where a building's leased and then you really heavily invest in it, so you've invested a lot of money, you've made it bespoke. And so given that you've put a lot into it and there's such a high level of investment, the reality is that you're highly unlikely to break the lease at the first lease break. So, it might be inappropriate to actually look at the first break in terms of that particular lease. So I think the intention around the lease is also really important, and we also need to look to that.
Okay, so we talked there a bit about capitalizing assets, about lease liabilities. So the question is, what do we need to do to make that happen? The answer on that is there's two key parts of this that we need to know. So first of all is what are we going to pay on the lease over the term of the lease? And that has got various different forms as shown on screen at the moment. And the second thing is what is the interest rate which we are going to discount those cash flows at, because this is essentially a large discounted cash flow model. Quick word at this point on lease modifications. I could easily do another hour's webinar just on those, but essentially once you have decided your original lease value and lease liability, any modifications are going to change how you recognise that asset and liability. And depending on the type of the change, because there's some pretty strict rules around how you modify it, you may end up having some significant impact on the P&L account from potentially de-recognizing a lease and starting again. So if you are post-adoption thinking about modifying any leases, then just be aware that that could introduce new volatility into your P&L. So the key question in all this, of course, is what is the discount rate? So there are three rates that are available. Two of which are on screen. The third one is specific to public benefit entities, such as charities, which Laura's going to touch on later. So what is expected to be the most common type of rate is the incremental borrowing rate. And this has a little bit of waffle around it, which essentially is the estimated rate for that lease, which we think a lessee would have to pay to borrow over a similar term with similar security to get a similar asset. Now that sounds very complicated. So why would it be the most common one? Because the alternative is the obtainable borrowing rate. And that is essentially what we think lessee would have to pay to borrow a similar amount of money over a similar term. Now, the problem with the OBR is that's quite difficult to get a bespoke observation for. Companies are quite complex in terms of what a lender will lend at. That's going to be quite difficult. I imagine they're going to be pretty reticent to go through a significant quote process to be able to prove some of this. And so we think that the IBR is likely to be the outcome and also maintains consistency with what you do in IFRS 16. So what is the IBR? Well, it's based on three key factors. So the first one is the reference rate, which is what is the currency, where are you undertaking that borrowing in. The second one is the financing spread. So essentially, what premium does the lender look at to lend to your specific business? So based on credit risk. And the third one is the asset type. So how risky is it to the lender? What sort of security is being provided? So this is actually quite logical. It sounds pretty complicated, but if you think about, for example, if a big company like Shell, BP, took a 30-year lease on a property in the UK, then clearly the UK is relatively stable. Shell and BP pretty stable, and a property for 30 years would probably be secured. So there's going to be a pretty low IBR on it. If you contrast that with if you lent to a sole trader so that they could get a lease for a car in North Korea, quite clearly you would want a significant premium on it and you would have a much higher IBR, because all of those factors would be riskier. So a quick example here without numbers in. We've got a lessee that runs a shop in a shopping centre. The rental cost depends on future RPI changes, and it also includes a turnover rent beyond a certain threshold. It also includes fees to arrange the lease in the first place. So what do we got to think about for the accounting? Well, firstly, the amount that we capitalise on day one. So what we're going to do is capitalise a right of use asset at the present value of the cash flows on the liability. To do that, we're going to have to guess what we think RPI is going to be across the length of the lease, and recognise that as a liability on day one. Turnover rent happily is ignored. We can just expense that as it's payable because that is a variable element to the lease. The fees are actually capitalised as part of the right of use asset at the outset. So the general rule would be that your day one asset and liability are equal to each other, and thereafter the right of use asset is depreciated and the lease liability is unwound at the original discount rate used. And all of the cash flows, essentially, we just present value these using the IBR or the OBR. So sounds hopefully relatively simple from that side of things. Obviously, in practice, it is quite a bit more difficult. Also to note that the RPI will introduce remeasurement volatility in the future. You are clearly never going to be able to estimate RPI correctly at the outset, so you are going to be constantly modifying that lease. Key impacts from this then? Well, probably the key one that many CFOs are interested in is that EBITDA is going to increase. Rent payments become depreciation and interest instead. So everything goes below the line for that. Obviously, this would appear to impact company valuations as a rule, and impairment calculations, because a lot of these tend to be based on EBITDA. So obviously there needs to be a shift in the multiples used. This is a process that listed companies went through back in about 2018 when IFRS 16 came in. So the market data available often includes the impact of this already. Lease commitment disclosure is going to be a lot lighter. Essentially, it's not there. There are obviously going to be more assets on the balance sheet because we're going to be capitalizing right of use assets. And this also means that there's a lot more testing of those assets for impairment. So this may bring in a bit more focus on concepts such as cash generating units that previously been ignored. We may well breach into new company size limits. We'll talk a bit more about those later, but this may push a small company up into the medium threshold. And it may also introduce volatility because those limits may change over time. And if you capitalize a 5-year lease, you have high assets in year 1 and 2, tailing off in year 3 to 5. So it may bump you in and out of thresholds in the worst case scenario. All this is going to have an impact on loan covenants. Obviously, if you are arranging anything with lenders at the moment, I would suggest that you have a chat around any relevant loan covenants, such as interest cover, EBITDA, net debt. All that needs to be factored in and considered. There are tax impacts of this, which Megan's going to go through shortly. There is a positive benefit. Alignment with listed companies improves comparability, so it allows you to better benchmark against big competitors. There are definitely going to be additional audit challenges to this, undoubtedly, and additional cost to preparation as well. This is not a simple thing to do. It is obviously going to be an ongoing thing, and it is going to take a time investment to do this. Obviously, to do that, is going to need some internal training. Welcome to the webinar today. Obviously, that has started that process. But you may want to consider outsourcing some of this to third parties to support with the key areas. For example, calculating an IBR is probably something that a lot of typical smaller entities are going to be unable to do internally. Transition to this. Well, the good news is this all happens on day one of adoption. There's no prior adjustments. Anything that was a finance lease, hire purchase contract before is generally going to be held at the same terms. Should be very rarely anything changes on those. But anything that was an operating lease before is treated as a new lease on the date of adoption. So if you are a December 26 year end, then 1st of January 26, you will enter into a whole host of new leases. And at that date, we're going to recognise a lease liability and a right of use asset equal to each other, discounted at the relevant discount rate. There is an option for anyone who has got a parent reporting under IFRS that they can use those carrying assets and liabilities to simplify the group position so they don't have to remeasure it specifically at that date for the subsidiary. And the final point is that if you're putting assets on the balance sheet, you need to consider if those assets are impaired at the date of initial application. So if you are a loss-making business and you may have mothballed part of a property, for example, this may create a loss to retain profits on day one, because the carrying value of the asset may be nil or a minimal number, but you would still need to recognise the lease liability in full. That's you, Laura.
Thank you. So quickly looking at charities again, there are often complex and non-commercial arrangements connected to leases in charities. So maybe a charity pays a peppercorn rent, it could get free or discounted rent, or there's just no formal agreements in place. And in practice, we see that quite a lot. So this all adds quite a lot of judgment and complexity into calculating the amounts around these arrangements and into charity accounts. So determining what the market value really should be. So Alex has looked at the discount rates as well, generally in quite a bit of detail, but the reality is that charities tend not to be borrowers, so the cost of capital or the discount rate can be quite hard to get behind, and at least a bit subjective. So that'll be another area of challenge for the sector. So we're likely to look at the market rates or the government gilt rates in terms of a steer on that in practice. So I've already talked about using market value for non-market transactions, and that'll create real volatility in the results for charities. So we'll be recognising big lumps of income when we capitalise the assets that have been gifted to us or discounted. So for example, when we capitalise at market value, it will create an asset that might need to be immediately impaired. So Alex has already mentioned the need to look at the value of these assets and determine whether they're impaired. And in reality, I think that we might see that quite a lot in charities, because sometimes people give things to charities and actually the charity would not have spent that money on it. It's not got that worth to the charity. And the lease adjustments especially will change the look of many sets of charity accounts and the balance sheet of many charities. So specifically thinking about charities with lots of charity shops or maybe care charities that have lots of properties. So the asset base and the liability base of those organisations will change quite significantly, and that will not just affect the assets of the charity, but also the free reserves, and maybe the reserve policies of those organisations will need to be reconsidered and looked at as well in readiness for these changes. Okay, so far we've focused mainly on the accounting. We've referred very briefly to the audit and what might happen, but I think it's really important to remember that there'll be an impact on the audit. And in reality, there's a fairly low bar limit to how much your auditor can support you with these transitions. So audit ethics are absolutely crucial to upholding the quality and independence in the audit profession. So as an auditor, we must audit information provided by clients to us. So we can't lead our clients to a certain answer. So there's lots of potentially material estimates and judgments in some of the changes that we've talked about. And ethically, your auditor's precluded from supporting you with any subjective valuation work. And that's just to make sure that the audit independence isn't potentially prejudiced. So understanding which changes will impact you, the extent of the change, and ensuring that you're prepared. So either using internal resource and making sure you've got enough people looking at it early on, or getting the right external support will be really, really important in making sure that the transition and the year-end audit for the first year-end is smooth. But just taking a step back from the nuts and bolts of the transactions, I think the level of challenge and complexity in the actual audit will also increase. So audits will become trickier. So if we look at the operating leases, for example, where you once had a simple operating lease, we'd look at the lease and we'd take the expense to profit and loss. You're going to see the auditors challenge that the length of the lease period that you've used, will challenge the discount rate that you've used, will start challenging a little bit more dilapidation provisions. And then at the end of that, you might well be asked to complete an impairment review on the asset as well. So it's content the auditors that the carrying value is fairly stated. So clearly lots of extra work. So extra work for the auditors and extra preparation from a client's perspective as well. So as I said on the last slide, we'll see the asset base of many organisations change. So from a reporting perspective, that could also see organisations move from being small into medium companies or medium into large. That too could bring extra work around it, so extra audit work around the disclosure in the accounts and extra work around actually preparing the accounts.
So one of the questions that often follows any accounting changes is what is going to be the impact on my tax position? So we've summarised in the next few slides the key impacts and any flags to look for on any more complex areas. Just to start with a bit of a caveat, so the official stance, HMRC have not yet issued any official guidance on this. However, the tax legislation that was implemented for the IFRS 16 changes and those accounting standard changes in Finance Act 2019 provide all the mechanisms that we expect to be able to deal with these changes. So in the market, it's widely expected that the same standards will apply. We're expecting that HMRC guidance pages are going to be updated in time to confirm their stance ahead of implementation. So starting with the leases, looking at all of the changes, the basic principles of your tax position don't change. So if you have something that was a revenue item, it will still be deductible as a revenue item as it would have been under the old standards. So where we have ROU assets, so right of use assets that have been capitalised, those effectively were operating leases, which were deductible revenue. So what we do now is they will be depreciated as they go through the P&L, and we'll allow that depreciation instead of adding it back. No capital allowances will be available on the leases on the balance sheet, so they're not fixed assets in the typical sense. We do, however, need to know how the initial value of those leases are calculated, because they might include things such as stamp duty, lease premiums, capital dilapidations, which are capital items, so wouldn't have been revenue in the first place. Where we have those included within that value of the lease, those still need to be disallowed. So it's working out the proportion of the value which needs to be added back each year to the P&L to reflect those items. We mentioned earlier that future lease modifications will change your interest rates and the calculation of the value on your balance sheet, but because of future lease modifications also including potential capital items, that add back may become worse if that happens. In terms of leases, a couple of other points that are worth considering. So if a lease is impaired, that's allowable if the lease is impaired in line with the accounting standards. Again, if we've got an element of disallowable capital in there, that proportion needs to be disallowed still. Similarly, on exiting a lease, so the profit loss on the lease would be allowable, but just remembering that disallowable proportion if there is one. Another question that comes up quite a lot is, what about the 15% disallowance for the high emission lease cars? Well, that's still going to apply, so we still have a lease of a vehicle. If it's still got high emissions under the definitions that we currently have, that restriction will still be applied. So we'll still need to know the CO2 emission of cars, we'll still need to know the lease payments per cars, and that will be applied to both the finance charge element and the depreciation of the lease vehicle that's gone through the profit and loss account in respect of the now right of use asset. Long funding leases, so these don't come up quite so often, but they are worthwhile knowing about if you do have them. So if they were accounted for as a right of use asset, they will be taxed as a long funding finance lease. But if you've already got long funding operating leases, those are grandfathered under these new rules. So that means we can continue the treatment that we've already got. So we don't have a transition for long funding leases that we already have. Generally, this is good news, the way that the value on a right of use asset is calculated means that the cost is front loaded as a result of how that the implicit interest rate is included. So you're likely to get more tax relief up front as opposed to as if you were paying through just normal lease payments as you are now. So you're likely to get tax relief slightly earlier because of that interest calculation. In terms of the transition adjustments themselves, so they're treated differently between the leases and the revenue recognition transition adjustments. In terms of the revenue recognition adjustments, the tax position basically gets you to the correct position under the new timing of recognition. So if we have some income that should have been taxed, but we're bringing it in now on the first day of the accounting period where the new basis is adopted, that will get taxed on that day. Similarly, if we have some expenses that we should have brought in under the new rules, they will get treated as being allowable on that first day. So any revenue recognition transition adjustments just get treated on the first day as either being taxable or allowable to get you to the position that you would be in going forward. If we can move to the next slide, please, Alex. Then in terms of leases, so some good news here that in the majority of cases, we won't have a transition adjustment. So as Alex spoke about earlier, the way that the leases are being recognised and the changes to those mean that we don't have a prior year adjustment. And quite often what will happen is we'll have a right of use asset, which is recognised at one value, and we'll have the lease liability at another value. And those will be the same. So in terms of that, we won't have any transition adjustments, so there's no tax impact. There is a very rare situation where these transition adjustments can arise, and if they do, they are much more complicated. So there's something called a mean average length of the lease that we have to spread that transition adjustment over. But in that case, tax advice would be recommended and may require some additional work there. Similarly to the tax position, deferred tax always comes up. So in this case, there'll be, similarly to the lease adjustments on transitions, no deferred tax. So the fact that there's no prior year adjustment and the income changes are recognised for revenue recognition on the first day of the accounting period, there's no difference between the accounting value and the tax value. So therefore, there's no deferred tax. The only way that you would get deferred tax is if in that rare case of having a transitional adjustment and that being spread, because you would get a mismatch between your accounting base and your tax base. So therefore there would be deferred tax considerations there. And again, would be recommended as part of that tax advice to get support with at that point.
Okay, so there are a handful of other changes to the standard to run through. So some pretty small ones. There is a one specific disclosure point that is coming in earlier, which is around supplier finance arrangements. Essentially, if a third-party finance provider pays an entity's suppliers, then there needs to be disclosures of that, and that is coming in from the 1st of January 25. In terms of the main changes, there is guidance to align the concept of fair value measurement with IFRS 13. Unlikely that's going to cause any particular problems, but if you are a company that is heavily impacted by fair value accounting, please do give me a shout and I can explain more. Going concern disclosures will now be mandated, including explanation of any key judgments around this. A lot of companies do tend to put this in anyway, especially outside of the small company environment. Very niche one is removal of new users being able to adopt IAS 39 accounting for financial instruments. You can still decide that you don't want to apply FRS 102's own rules for financial instruments, but you will now only be allowed to start using IFRS 9 instead. There's a bit of a clarification around some share-based payment accounting, but nothing really changes. And quite a bit of guidance as well around uncertain tax positions. So you should only show a certain tax position if it's probable that a tax authority would accept it if they had full knowledge of that information. There is, however, one other big change to run through, which will not impact most people, but this is goodwill versus remuneration. So this has existed in IFRS for many years, but it is now coming into IFRS 102 formally. It was previously silent on the matter. But if an SPA includes a payment to the former owners, which is variable and relates to ongoing employment. So in other words, if you put an earn-out agreement in and you have to stay employed for the 2-year period of that earn-out to get entitlement to it, then that is prohibited from being recognised as goodwill in the group accounts, and it has to be recognised in remuneration. Now, this has got two main impacts. So firstly, your reported EBITDA will be lower, and so your net assets will be lower as well. And covenants may well be impacted by this, as they often look at EBITDA terms. So to explain this a little bit, if we've got an acquirer that buys a target for £20 million, plus an earn-out payment of up to £6 million, which we expect to be settled for £4 million, and that earn-out requires the vendors to stay in employment for 2 years until that payment date for the earn-out. After that time, they're free to leave. We were planning to amortize goodwill over 12 years, and we've got net assets of 2 million. So what is the accounting for this? So without going through the details of this calculation, what we have on screen is the flow through the 2 years. So we can see that under existing EBITDA, it's silent on it. I have seen different interpretations of this, but I think the most common one used is that it just goes into goodwill. And therefore, we would spread that goodwill over the life. It would have no impact on EBITDA from amortizing that goodwill, and our retained earnings in the group would just fall by the amortization of that goodwill. However, new FRS 102, what we're going to have to do is recognise £2 million a year, so £4 million for 2 years, as a loss to EBITDA. We are going to amortize a slightly lower goodwill number over the same 12 years. And this means that we are significantly impacting retained earnings in those first 2 years, as well as reporting a much lower EBITDA. So this is clearly something that a lot of businesses can be quite sensitive to. EBITDA being a key metric for a lot of private equity businesses, who obviously will typically consolidate. So it is an area to be careful of. Ultimately, the commercial decision may be it's still right to tie the people in for that period and link it to the earn-out, in which case consider yourself forewarned as the accounting treatment, but it may be an additional factor to bring into any significant deals that you may be doing.
So just thinking about the tax position on that. So whilst the accounting disclosure changes, again, the tax position will remain the same as what the position currently is before the accounting disclosures have changed. So what we'd recommend here is the tax position on an earn-out should be reviewed at the point of the earn-out structuring, because it can be quite complicated, and it depends on the terms of that earn-out, factors such as whether all investors get the same rate of earn-out, whether they remain employed or not, and lots of other things such as that. And that will also affect the individual's tax position. So you'd expect that if the individual is getting capital treatment, it will be capital for the company. And if it's remuneration for the company, that's remuneration for the individual. So again, that's the point at which we need to do that review, and I'd recommend that on any earn-out structuring anyway. Broadly, if it's consideration for shares, so if as part of that tax review we say, yes, this is capital, it's not to do with the continued employment. This is consideration for the shares that are being sold. It will still be capital and it won't be tax deductible for the company. If it is seen to be remuneration, it will be akin to a bonus, so it will be taxed as PAYE and national insurance, assuming that's cash settled, and that is a deductible expense for tax purposes.
Okay, so just as we wrap up, we'll take a quick consideration of the expected 1A changes. Okay, so the measurement criteria in section 1A of FRS 102 is substantially the same as full FRS 102. So everything we've talked about today will impact the measurement of the amounts in a set of 1A accounts. This periodic review does, however, bring in many changes in terms of mandatory disclosure in 1A accounts. So many of these were recommended in the last standard, so they were an appendix of the current version, but they weren't mandated because of the then EU legislation when that standard came out. So new mandatory disclosure includes a narrative around going concern, so why the accounts have been prepared on a going concern basis, more disclosure around revaluations and unrealised gains in the accounts. Just bob on to the next slide for me, thank you. We've got full share-based payment disclosure, the current tax charge and a full tax reconciliation and dividend payment disclosure also. So those are the key ones, but you can see it's quite an expansive list of new mandatory disclosures. So just to look at the impact of that, I think could be quite pervasive. So there'll be much more information publicly available, and this works in tandem with the Economic Crime and Corporate Transparency Act, where we're also going to see full profit and loss accounts filed with statutory accounts. So these small sets of accounts will start to look much closer to the medium sets, and the comparability will be easier, but there'll be a lot more information publicly available for small companies. So it feels very different to where we are now, and I think it might drive some different behaviours from business owners and finance teams. So the disclosure of dividends could change the remuneration planning strategy. So, the commercial sensitivity of having the disclosure around the dividends might become more important than the modest tax savings generated by the individual by being paid by dividends, for example. In addition, the level of disclosure and complexity around the balance sheet arrangements do start to increase the professional support required by accountants, even by these smaller entities. So there'll be a time and cost implication there too. And just to mention FRS 105, I think that maybe starts to become a little bit more attractive for the smallest of UK entities. So we do start to see very much more of a two-tier system in the UK. So I think the key driver for that will be the on-balance sheet leases, which we don't see as a requirement of FRS 105. So if we take an example of a small retailer, if they prepare FRS 105 accounts where the balance sheet hasn't got the leases on, as opposed to a set of 102 1A accounts where they are on, the balance sheet and the accounts will look very, very different, but for the same business.
Okay, very quick update on company size limits. So this is probably the slide we've rewritten the most because it's all changed in the last few days. So back in March, there was a lot of chat about the size limits increasing and coming into effect from the 1st of October this year. They were going to be laid before Parliament in summer. Obviously, there wasn't Parliament during summer. And just in the very last few days, there have been new proposals that these increases will apply from the 6th of April 2025. Thresholds are yet to be confirmed, may well be the same as they were before, but a proposed increase to medium company thresholds might not be happening. So essentially watch this space. Obviously, we will be sending out some information on it once something is confirmed, but the expectation would be that the small company size threshold will increase, and importantly, that theoretically should increase the audit threshold at the same time. So that's the end of our slides. We have done a detailed publication on this, which is available on our website. We'll send this link around with the slides at the end of this webinar. And finally, thank you for attending this morning. And we will now go on to the Q&A part of the session for the last few minutes.
So we've got one question that's come through the webinar chat. So that says, do subsidiary companies need to show ROU assets for properties owned by the holding company and rented to the subsidiary?
Okay, good question. So it would depend as to whether or not these are actually under a formal lease. So if it is something where the subsidiary has got no contractual right to use it, then I think generally speaking, wouldn't expect this to appear on that balance sheet. Because there is an absence of the definition of lease that says you need to have the right to use it for a fixed period of time. If that is a contractual lease between parent and subsidiary, then that is a lease from the subsidiary's perspective, regardless of who the counterparty is, and therefore you would need to recognise that asset and liability in those subsidiary accounts.
So there's one here about charities. So like you said, contracts can be vague in charities. So can gifts in kind, including whether for parent charity or trading sub, could this have tax impacts for charities with subsidiaries?
Sorry, I'm on mute. Um, I think potentially, and it's definitely something worth thinking about. Usually, we gift aid the profits up, and we manage to manage any potential tax liabilities that way. If there's a timing difference in terms of how things unwind, we do sometimes end up with an unintentional tax charge. So I think this is part of the planning, trying to work that through to make sure that that's not where we end up with it. But I mean, if there's a specific example with numbers in there, I'd be happy to take it offline and have a look at that with the person who asked the question.
We have had another one. So can you clarify if Section 20 applies to SMEs as IFRS 16 apparently does not apply to SMEs?
Yes, it does. So any measurement for leases is exactly the same for small companies as it is for medium and large companies.
Brilliant. There's another one here. So what is the impact of lease accounting on when a company needs an audit?
I think it will be the gross asset. So if the company has gross assets in excess of 5.1 million and either the employee or turnover thresholds are breached for 2 years, it will need an audit. So by capitalising the assets, it will increase the gross asset base and potentially take you into audit. As I said, we've got the 2-year period, so that is actually it will happen the year after transition. And it's further complicated by the potential of the company size limits changing and an expectation that perhaps the audit thresholds changing off the back of that. And obviously these assets are depreciated as well. So as the assets are depreciated away, you might find yourself falling in and out of audit as you buy and depreciate these lease assets. So it could get quite complicated in terms of audit.
Brilliant. There's one here about VAT, so I'll pick that one up. So what happens with VAT recovery on the lease? So similar to a lot of the tax impact, not a lot changes. So the VAT recovery, again, the substance of what you've got doesn't change. So the treatment that you're using now will continue under the new standards, and there'll be no difference in the VAT treatment. I'm not sure if this is a question or a comment, but maybe size impact for environmental reporting too. So I think that perhaps feeds into the question, Laura, on the audit threshold.
Yeah, so it would change the director's report requirements. So if you become small to medium or medium to large, the director's report requirements would also follow.
And then a final one, unless there's any more that anyone wants to add in, what would you advise to prepare before adoption?
So it's probably quite a wide question on that one. I think the main question would be what sort of business are you, and are you planning to do anything where there's likely to be greater scrutiny on the accounts over and above kind of normal commercial and audit basis? I think probably the key thing is to make sure you're on top of your leases. Identify your adoption date when you have to apply FRS 102. If there's any simplifications you can make to the leases, any commercial changes that you are planning to do at some point that can be made before that date, that is going to avoid some future problems. But it's really sort of understanding what you've got and what it's likely to look like on the balance sheet post-adoption so that you're forewarned of any potential impact, as we talked about with size limits, additional reporting changes, volatility in the P&L. And then for anyone who is considering a deal, obviously make sure that you embed any changes in covenants in to take account of potential EBITDA changes as a result of leases, goodwill versus remuneration. And if you are thinking of signing any particularly unusual revenue contract, then I would probably make sure you have a chat with someone relevant on this to pick up any potential pitfalls that may come out of those that could surprise you, really. It's all about planning, to be honest, at this stage. So just make sure that you understand what the potential impact of anything that you're thinking of doing is, and try and engage with the various stakeholders so they understand what may change.
I think if you're a charity as well, just understanding the contract. So make sure you understand what the contracts are, how the price allocates, and the performance conditions in there. And if you look at the contracts and it's ambiguous, you've got 18 months to get clarification around that and get everything straight.
We do have another question. So, I mean, it's brilliant. We've had so many questions this morning. Does the ROU asset form a new asset note, or do they fall into the existing fixed asset note?
So it's a good question. I believe there is an option as to how you want to present it. There's certainly an option under IFRS, and I think that has been replicated in the standard as well. So you can either include it in the main asset category and then disclose separately what the value of ROU assets is, or you can actually put in a separate note to the accounts. Conscious of time here, we've just over a couple of minutes, given we had so many questions. So just to say thank you to everyone for attending. If you have any questions, then please do follow up afterwards with us. We will circulate contact details along with the webinar slides and recording. Hope you all have a great rest of the day. Thank you very much.